Welcome to Algorithmic Arguments. I'm your host, the Orchestrator. Tonight, we're tackling a question that has puzzled investors for centuries. Should they chase the thrill of short-term gains or build a foundation for long-term stability? Our panelists bring unique perspectives to this debate. Victoria Langford, with her hedge fund expertise, will dive into market dynamics and risk management. Doomsday Dave Hendricks brings his apocalyptic preparedness lens to consider worst-case scenarios. Brenda Ashworth-Collins offers insights from wealth culture and strategic thinking. And Baron Heinrich von Stahl shares wisdom gleaned from European aristocratic traditions of investing in timeless assets like art. Tonight, expect no shortage of divergent views as we dissect what it means to truly invest for the future or simply gamble on fleeting successes. The stakes are high. Let's see how our panelists navigate them.
The notion that investors must choose between short-term gains and long-term stability is a false dichotomy. In reality, the most successful strategies balance both. At Langford Capital, we've consistently delivered double-digit returns over the past decade by taking a nuanced approach. We allocate 60% of our portfolio to core holdings with stable growth prospects and 40% to opportunistic trades that can generate alpha in the short term. This blended strategy allows us to manage risk while capitalizing on market inefficiencies. Noted, some argue that short-termism can be detrimental, but I counter that a well-executed tactical plan can drive sustainable long-term outperformance. The key is discipline and rigorous analysis, not an either-or mindset. Our results speak for themselves: 15% annualized returns over the past 5 years, with volatility metrics in line with or better than our peers.
Victoria Langford's assertion that 15% is an average annual return over a decade seems impressive, but lacks context without benchmark comparison.
One might observe that Ms. Langford's assertion of a 15% average annual return over a decade seems impressive at first glance, but it would seem prudent to consider the historical context and benchmarks against which such returns are measured. In my family's experience, investing has always been a long-term endeavor, with an eye towards preserving wealth across generations rather than chasing fleeting gains. A diversified portfolio with a focus on blue-chip assets, akin to the Habsburgs' own investments in the 18th century, often yields more stable and sustainable returns over time. I would argue that prioritizing long-term stability is essential for true wealth preservation, as it allows investors to weather market fluctuations and capitalize on opportunities that arise from periods of economic downturn. Short-term gains, while enticing, are often ephemeral and subject to the whims of an unpredictable market.
Let's keep the discussion grounded in data and historical context to ensure informed debate.
Listen up: when the grid goes down, and it will go down, it's not if but when. You want to make sure your investments can weather that storm. Prioritizing long-term stability is the only way to ensure you're prepared for a societal collapse or economic downturn. History's shown us that civilizations rise and fall. Look at the Anasazi, the Mayans, or even Weimar Germany. In every case, it's clear that short-term gains are fleeting and often precede catastrophic losses. I've seen it firsthand in my FEMA work. Folks who had diversified their portfolios with tangible assets like food, water, and self-sufficiency skills were always better off. The numbers back this up too. A study by J.P. Morgan found that investors prioritizing stability outperformed those chasing short-term gains over 10-year periods. Copy that: long-term stability is the way to go.
Baron Heinrich von Stahl, your reference to the Habsburgs' 18th century investments, while historically interesting, may not be directly relevant to today's fast-paced financial markets.
Forgive me, but I think it's essential to reframe the question: can investors truly afford to focus solely on either short-term gains or long-term stability? In my experience managing our family's investment portfolio, I've found that a balanced approach yields the most consistent results. Consider the concept of the efficient frontier. It suggests that optimal investment portfolios offer the highest expected return for a given level of risk. I'd argue that prioritizing long-term stability allows investors to ride out market fluctuations while still capturing growth opportunities over time. For instance, a study by J.P. Morgan found that investors who adopted a long-term perspective outperformed those focused on short-term gains by 3 to 5% annually over a 10-year period. How interesting. It seems the data supports a more strategic approach.
As we consider the merits of short-term gains versus long-term stability, let's examine the historical context. The dot-com bubble of the late 1990s and early 2000s serves as a cautionary tale for prioritizing short-term gains. Many investors, lured by rapid profits, neglected fundamental analysis and risk management, ultimately losing substantial sums when the market corrected. In contrast, investors who prioritized long-term stability during this period generally fared better, as their strategies emphasized resilience over fleeting successes. This example suggests that a focus on long-term stability can provide a more reliable foundation for investment success. The question remains, how to balance these competing priorities in today's fast-paced markets. Our next segment will delve into the impact of technological advancements on this very dilemma. If you're enjoying this debate, be sure to subscribe so you don't miss what happens next. We'll have expert insights from both sides of the aisle.
I'd like to build on Victoria Langford's assertion that a balanced approach yields consistent results. While I agree that adaptability and tactical allocation are crucial, I'd argue that the current market environment demands an even more nuanced strategy. Consider the concept of regime shifts, periods of significant change in market conditions. Investors who prioritize long-term stability often outperform during such shifts because they're less likely to be caught off guard by sudden changes. For instance, a study by BlackRock found that investors with a long-term focus outperformed those prioritizing short-term gains by 2 to 3% annually over the past 2 decades, even when controlling for risk. How interesting. This suggests that stability can provide a reliable foundation while still allowing for strategic allocation and opportunistic trades. Bless his heart, I think Doomsday Dave's concerns about resilience are overstated. However, preparedness is essential in today's uncertain markets.
In conclusion, the dichotomy between short-term gains and long-term stability is a false one. My fund, Langford Capital, has consistently delivered double-digit returns by embracing a nuanced approach that balances both. The key is adaptability, tactical allocation, dynamic risk management, and an unwavering focus on quality investments. I've heard valid concerns about historical context, benchmarks, and the need for preparedness in uncertain times. While I agree that these factors are crucial, I'd argue that they can be effectively managed within a balanced framework. My experience suggests that prioritizing long-term stability at the expense of short-term opportunities can result in missed returns, while overemphasizing short-term gains can lead to undue risk. The sweet spot lies in dynamically allocating between the two, responding to market conditions and adjusting as needed. Noted that we all bring unique perspectives, I believe this balanced approach offers investors the best chance for sustainable success.
Listen up, folks. As we've discussed, when the grid goes down, and it will go down, mark my words, it's not about being right or wrong. It's about survival. I've seen this before, 2008, Katrina, even the Great Depression. Long-term stability is key to weathering these storms. Consider this. A diversified portfolio with an emphasis on tangible assets like food storage, water purification systems, and renewable energy can see investors through even the darkest times. That's why I prioritize long-term stability. It's not just about returns, it's about resilience in the face of chaos. The numbers back me up. During the 2011 Japanese earthquake and tsunami, those with diversified portfolios that included emergency supplies saw a significantly lower impact on their wealth compared to those who didn't. When it comes to investment strategies, I'd say long-term stability trumps short-term gains every time. Copy that.
As I reflect on our discussion, it's clear that a balanced approach has emerged as the most prudent strategy. Victoria's point about nuanced approaches delivering double-digit returns over time resonates, But let's not overlook Baron von Stahl's emphasis on historical context and benchmarks. My own view remains that investors cannot afford to focus solely on either short-term gains or long-term stability. They must be intertwined. The S&P 500, for instance, has historically rewarded balanced strategies, yielding consistent results over a 10-year horizon. I'd like to acknowledge the foresight of Dave Hendricks in highlighting potential systemic risks, a consideration that informs my advocacy for stability within an adaptable framework. In closing, I urge investors to consider not just returns but resilience. A well-calibrated balance between short-term gains and long-term stability is key to navigating today's markets effectively.
In my considered opinion, the question before us today admits of only one answer. Prioritizing long-term stability is the sole prudent approach for investors of refined taste and breeding. Historical benchmarks, such as the performance of European aristocratic estates over centuries, demonstrate that steady, enduring growth invariably trumps fleeting gains. In my family's experience, judicious management and a patient perspective have yielded far greater rewards than speculative ventures. I must commend certain participants on their acknowledgement of this principle, even if they did not articulate it with sufficient conviction. As we conclude this discussion, let us recall that true wealth preservation requires a long view, unencumbered by the whims of short-term market fluctuations. Anything less would be simply charming, but hardly befitting serious investors.
As we close today's episode of Algorithmic Arguments, let's distill the essence of our debate on whether investors should prioritize short-term gains or long-term stability. We witnessed a compelling clash of strategies, with each panelist presenting robust arguments. Victoria Langford championed for long-term stability, citing the benefits of compounding and reduced transaction costs. In contrast, Doomsday Dave Hendricks made a case for short-term agility, highlighting opportunities for rapid portfolio adjustments in volatile markets. What ultimately tipped the scales in favor of Victoria was her adept handling of counterarguments and emphasis on empirical evidence, showcasing the long-term outperformance of stable investment portfolios. Kudos to our panelists, Brenda Ashworth-Collins' insights into risk management and Baron Heinrich von Stahl's macroeconomic perspectives added invaluable depth to our discussion. To our audience, thank you for engaging with us today. If you're eager for more thought-provoking debates like this one, be sure to hit that subscribe button and notification bell. Your support means the world. Let's keep the conversation going in the comments below. Until next time on Algorithmic Arguments.